Welcome to Westbrook's COVID Conversations Series, Episode 6. Today we're joined by Erich Bell. Erich is a director in the tax division of Werksmans Attorneys, specializing in, amongst others, domestic tax advisory. The idea of the conversation today is to chat around some of the further tax measures that have been put in place to combat the COVID-19 pandemic. Erich, thanks so much for joining me.
Thanks so much for having me.
Erich, maybe to start, on the 29th of March, we heard National Treasury announce an initial set of measures to assist tax-paying entities with cash flow measures in the context of COVID. National Treasury then at the end of April came out saying that they accepted that that wasn't enough and announced a further 70 billion rand worth of measures and support to assist cash-strapped entities. We've obviously in previous COVID conversations discussed issues like TERS, a government loan scheme, but I understand that there are a number of other measures that owners of small businesses and even medium and larger businesses can take advantage of during COVID. Can you maybe elaborate on these?
Absolutely. Look, from the outset, it's quite important to emphasize the fact that a lot of these relief provisions only apply to SMEs, which basically refers to any type of taxpayer who's tax compliant with an annual turnover of less than 100 million, where less than 20% of their annual turnover comprises passive income, which consists of dividends, interest, rentals, and royalties. And there's an exception for taxpayers in the property trade who mainly derive their income from rental, or mainly derive rental income from the letting of fixed property. In that regard, if less than 85% of their total gross income for the year of assessment, or if more than 85% of their gross income for the year of assessment are attributable to rental income, then they don't need to take rental income into account. So that's basically the definition of an SME. So if you look at the relief measures that were introduced based on cost to the fiscus, the biggest relief measure is the deferral of employees tax, and that had a cost to the fiscus 21 billion. Followed by that is the employment tax incentive changes, in terms of which the incentive is expanded to other employees. We'll delve into that in a bit of detail. That's coming at the cost of 15 billion. And then also the deferral of provisional tax comes at a cost of also 15 billion to the fiscus. Looking at these changes holistically, I do believe government can be commended. I think they're going the extra mile, especially in assisting SMEs. In the latest media release, subsequent to the initial release of the bills, Treasury has conceded that more should be done for large businesses, and that large businesses can apply to SARS on sort of a manual basis in order to request the deferral of their tax debts. All in all, I do believe it would go quite a while in assisting the economy and small businesses.
So Erich, let's start going into some of the measures available. I think you mentioned the first was the deferral of pay-as-you-earn. Absolutely.
So what that entails is they're allowing employers to basically withhold 35% of the pay-as-you-earn that they deducted from the employees' salaries for the months of April, May, June, and July, only for a 4-month period. And the purpose is to allow employers to redeploy that 35% into their businesses and to assist them with their cash flow needs. This deferral, this 35% deferral that they are withholding on a monthly basis, must then only be repaid in 6 equal monthly installments, and that's from beginning from September 2020. No penalties and interest would be imposed for the deferred portion of the employees' tax, provided that it's repaid to the annual installments as from September 2017. It's September 2020.
And Erich, what other measures are available, and how can these be utilized by SMEs?
The thing that caught my attention is the changes to the Employment Tax Incentive Act. So how the Act works and what its purpose is, firstly, is to encourage employers to hire young South African work seekers between the ages of 18 and 29. And how they incentivize the employers to do that is that the government is effectively funding a portion of those employees' salaries. And it does so by allowing an employer to reduce the employee's tax that he withheld from the salaries of his other employees who are above the tax threshold. So the employment tax incentive specifically applies to employees between 18 and 29 if their remuneration per month is less than 6,500 Rand. The maximum amount of the incentive that can currently be claimed is equal to 1,000 Rand per month, and that's if the employee earns between 2,000 Rand and 4,500 Rand a month. What important is that the employment tax incentive can only be claimed by an employer in respect of a particular employee for a period of 24 months. And the incentive is also reduced by 50% in month 13 to 24, in other words, in the second 12 months. So the maximum benefit you can get in the second 12 months is equal to 500 Rand. Looking at the changes, the most significant change for me insofar as the employment tax incentive is concerned is that the monthly incentive per qualifying employee is increased by 750 Rand for qualifying employees. To give you sort of a taste of the significance thereof, if you, for example, employ an employee who's earning a monthly remuneration of 2,000 Rand, the employment tax incentive for that employee will now amount to 1,750 Rand. So government is effectively funding 87.5% of the salary of the employee, and that's even before taking into account that the employer obtains an income tax deduction for the remuneration paid to the employee. So in that particular case, close to 100% of the salary of the employee is actually funded by government. The second big change to the employment tax incentive relates to the fact that they've extended it to qualifying employees earning less than 6,500 Rand again, who have already been employed for 24 months and who are therefore ineligible. The employer is ineligible to receive the incentive in respect of it. This applies for the months of April, May, June, and July. They've also extended the incentive in the amount of not more than 750 Rand to all other employees who earn less than 6,500 Rand, if provided that they're between the ages of 30 and 65 during the month in which the employment tax incentive is claimed. The last change to the employment tax incentive relates to the refunding of excess credits. So before I delve into that, let me just first give you sort of an explanation. As I've said earlier, the employment tax incentive reduces the employee's tax that an employer must withhold from the remuneration paid to the employees and pay over to SARS. The employees in respect of which the employment tax incentive is claimed earn a salary that falls below the tax threshold. In other words, they're not subject to tax, and an employer is also not liable to withhold employees' tax from their salaries. It does, however, receive this incentive per qualifying employee. This incentive must then be applied to reduce the employee's tax withheld by the employer from the higher earning employees. If the employment tax incentive for a particular month exceeds the employee's tax and must withhold, then that excess portion must be rolled over to the following month, and it will again, with the employment tax incentive for the following month, reduce the employee's tax of the employer in that month, the end of August and February each year, in which case any excess ETI credits are refunded to an employer. So the change, which is quite welcome here, is that for the next 4 months, this refund mechanism will take place on a monthly basis as a payroll basis. And that's again in order to assist the entities with their cash flow constraints during this period. A change going hand in hand with the employment tax incentive relief is the SDL holiday. So in layman's terms, if an employer as an annual remuneration or payroll bill more than 500, that employer is liable to award SDL at 1%, or to provide to pay SDL at 1% to SARS, equal to the monthly remuneration. So this SDL dispensation basically exempts all employers for the months of May, June, July, and August from having to withhold any SDL whatsoever. It's important that this is an exemption. It's not a deferral similar to the employee's tax. Also sort of related to that is the provisional tax relief, which is again a deferral mechanism. And what it entails is that your first provisional tax estimate, which is usually based on 50% of your estimated taxable income for the year of assessment, which is due between 1 April 2020 and 30 September 2020, now only needs to be based on 15% as opposed to 50% of your estimated taxable income. Your second provisional tax estimate for the period between 1 March 2020 or 1 April 2020 rather than 31 March 2021 only needs to be based on 65% of the total estimated taxable income as opposed to 100%. This deferred portion of provisional tax must then be paid by the taxpayers as part of the third voluntary top-up provisional tax payments, which is usually done in order to prevent the accrual of interest. They do typically 6 months after the taxpayer's year of assessment. And important to note on this change is that it only applies again to SMEs, so your taxpayers with an annual turnover of less than 100 million.
And Erich, maybe finally, the fast tracking of VAT refunds?
Yes, again, similar to the other proposals, it's aimed at assisting your smaller type of taxpayers. So generally speaking, most vendors with an annual turnover of less than 30 million are registered as either category A or category B vendors. And the implication is that they've got 2 monthly VAT periods. So if your input tax credits as a vendor for any particular month exceeds the output tax charged by you for that month, you're in a refund position. You can, however, only get the refund once you've submitted your tax return and SARS having verified the submissions made in the tax return. Again, if you're category A or category B, that can only take place on a bi-monthly basis. So these vendors can usually only obtain their refunds once every 2 months. What the change entails is that these category A and B vendors are now allowed to submit their VAT returns on a monthly basis for the next 4 months, so that any refunds that are due to them can be released on a monthly basis as opposed to bi-monthly basis.
Erich, that's extremely helpful, and clearly a lot of work that's gone on with National Treasury in assisting SMEs during this time. Those mechanisms that we've discussed today include a PAYE deferral, provisional tax deferral, the SDL holiday, fast tracking of VAT refunds for small businesses, as well as changes in the employment tax incentives. Erich, maybe just a final question. There's obviously a lot of detail involved around all of these incentives. What happens if a small business out there is looking for more advice or more detail in how they might benefit?
Yeah, look, they can obviously contact us or speak to their registered tax practitioners to assist them. I do believe that this course should be extended to your larger businesses also, being those with an annual turnover in excess of 100 million per year, as they are also feeling the brunt of the lockdown, especially in the tourism and property sectors. So yeah, they should speak to their advisors, and if need be, if these relief measures are not enough, they can apply manually to SARS for developments in respect of their tax debts without any penalties being incurred. Interest would obviously continue to be levied.
Erich, that's extremely helpful. And if you've got any further questions around any of these incentives, whether you're a small or a large business, be in contact with Erich Bell. Erich is a director in the tax divisions at Werksmans Attorneys. Erich, thanks so much for the time.
Thanks so much for having me. Appreciate it.